Welcome back to Notes Edition, where I read notes off of my phone. Today's note is called, What are stablecoins? On the surface, stablecoins are pretty straightforward. They're cryptocurrencies pegged to the value of fiat currencies like the dollar. As Bitcoin and other cryptocurrencies rise and fall in price, stablecoins are meant to retain a stable value. One coin equals $1. So let's say you're trading the Bitcoin markets. If Bitcoin starts moving too high too fast, you may want to take profits if you think the price is due for a crash. When you cash out into a stablecoin, you can essentially keep your trading balance in crypto without cashing out to actual US dollars. If the Bitcoin price crashes back down to a fair value price that you're more comfortable with, you can then use your stablecoin balance to buy Bitcoin back at a cheaper price than if you'd simply held through the boom and bust. Stablecoins can make the trading experience a bit more seamless, but what's the downside? The most obvious downside to any given stablecoin is that because they are only pegged to depreciating assets, they don't hold value for the long term in the same way that dollars don't hold value for the long term. The real risk with stablecoins is that although they are meant to maintain value pegged to the dollar, they still require consumer demand. Because stablecoins aren't as spendable as normal US dollars out in the economy, it can be a delicate balance getting a stablecoin to perfectly match the value and demand of the dollar. For instance, after a trade is done, who is going to want that stablecoin? If a stablecoin can't be spent directly on goods and services, you're most likely going to want to trade your stablecoin for real dollars in your bank account, which puts selling pressure on the stablecoin and buying pressure on the dollar. This divergence in demand can cause a stablecoin to break. In fact, in May 2022, the Terra USD stablecoin cracked under the weight of one of Bitcoin's biggest price crashes. Once the peg for a stablecoin is broken, demand for that stablecoin tends to plummet, now devoid of its only feature. Stablecoins provide a fantasy of convenience that can be shattered once the music stops. The least obvious risk of stablecoins is the most fundamental. Who gets to issue stablecoins? Each stablecoin uses various methods to achieve its peg, from treasury backing to algorithms to liquidity backing, but the most important question to ask is why? Why are BlackRock and others involved in backing stablecoins? The biggest risk to society long-term is the social implications of stablecoins. Banks and governments are already involved in stablecoin development, which could provide a Trojan horse for a central bank digital currency replacement. The public is already very wary of allowing or adopting a CBDC, yet a stablecoin can have identical features under a different label. As stablecoins become more user-friendly, most people won't be able to tell the difference, completely unaware of the game they're playing. Not all stablecoins are the same, but being able to distinguish between safe and unsafe digital assets will be vital to survival in the coming decades. The higher your financial IQ, the better your chances of preserving your hard-earned energy. And that's today's note.